again, I'm Chris Davenport. The name of our company is Today Lending. Basically what I want to be able to go through is get it a little bit more detail of what she covered previously. There were some terms in there that we need to really kind of drill down on, because can I get kind of a pulse of who's here to purchase a home as opposed to the lease program? Purchase. Lease.
I'm just here.
You're just here? Me too, just being.
I'm sorry, what's the difference between the lease program and the?
Well, the lease is just exactly that. It's a lease to own. Whereas the home ownership program is you receive $25,000 from the tribe. That's why you're here, to take the class requirement, and then you own the home.
Okay, I have a question. Are those two programs separate from the having a home built with land ownership?
You can do it both. Okay, so one of the ways that you can do this, there's actually a couple different ways, and it depends upon your finance program. The grant assistance is for you to purchase a home, and they can use it to build a home as long as it is your first home.
Awesome.
Okay,
Wow.
so it can be structured in several different ways, and you can, if you own home, or if you don't own home, or own land, I'm sorry, then you can buy land and build a home. You can buy land and put a manufactured home on. You can, if you already own the land, you can do the same, put a mobile, manufactured, modular, or build from the ground up. In the state of Oklahoma, you're just capped out at $271,000 for the loan amount. Okay, but that's kind of misleading a little bit, because you still have to meet their income. You can't exceed their income requirements for the grant. But the loan program, which is what I'm going to talk about, which is the HUD 184 program, it does not have income restrictions. And that's one of the things that I really wanted to clarify up front. There are two processes here. There is the grant program. They have their requirements, they have their process, they have their paperwork. Then you have your lending, which has its own requirements, its own guidelines, etc. They don't necessarily, even though we overlap quite a bit in paperwork, each one has to have their own paperwork, their own process, and so forth. And sometimes whenever people are going through, it's like, well, I gave all that to Melba. Well, but there's another part of this, there's your loan process. And so we need that as well, or we might need additional things. One of the things, and I'm gonna get into budget in a second, but with that, it just, if you were not using the grant program, then the HUD 184 program, which you mentioned a little bit earlier, it just requires 2.25%, and it doesn't have any income caps. Like what you were concerned with, well, our household income is too high. It doesn't allow us to get the 25,000. Well, that doesn't mean that you're blown out of the water. It just means that you might have to, if you went with the HUD 184 program, put 2.25% down. There are other financing options that are awesome as well. You mentioned that reserves, there's VA that could become available to you once they've been in 6 years. USDA is really popular in this area, which is a 100% financing program. And each program, but that program does have income requirements and location specific requirements and so forth. Whereas the HUD 184, wherever you want to go within the state, you have no income caps, and you can do, it's pretty flexible. It's probably one of the most flexible programs out there. It doesn't have any credit score requirements, but don't let that mislead you. It doesn't mean that it's a bad credit program. It's not. It's just that we don't have a credit score requirement. You just have to have 12 months of on-time payment history, and if there's any collections, they just have to be settled. And then everything else goes on debt to income ratio. Now, debt to income ratio is going to lead me into budgeting. okay? Because really what we focus on is this is a tight-knit community, and we want people, if they're going to purchase a home, we want them to succeed. Purchasing is not for everybody. You know, you might be blessed in that everything in your life works out exactly the way that you expect it to. Everything that is supposed to cost X amount always comes in on budget at X amount, and that's awesome. I'm gonna speak to everybody else who that doesn't happen to. So I'm gonna go through some basic definitions of things, just so that we're all on the same playing field here, and we kind of understand. I expect to be interrupted, so if you have any questions, please just talk. Okay. Now, let's go through these basic definitions so that we understand what things in your life that in budgeting that you can control. Fixed expenses is also referred to as installment loans. There are two types of credit. You have installment loans, which are like a car payment, where I pay $300 a month each and every month, and it does not increase. That's a fixed expense. It's also called an installment loan. Then you have revolving credit, which is a credit card. It's going to fluctuate on your balance, or if you're with some banks or under some construction loan programs, it'll be variable based upon market conditions. So you have to be able to budget if you're going to go into something that is variable. Now, also, outside of loan terms, as it states here, we have groceries, utility bills, so forth. Again, groceries don't tend to go up in price. They seem to be fairly consistent. Utility bills, I've never had a utility bill go up. Have you? Yeah, so that doesn't happen too often. But, for those again that did a bad joke, sorry. But in budgeting, you have to expect things to go up. You have to expect things to change. You have to have kind of what if. And in doing that, sometimes you gotta pull back on some of your expenses to have that contingency. Planned savings. I can't stress this enough. I know how hard it is, especially with everything that just seems to go up in price, and everything's so much more expensive than it should be, number one, and than we expect. But in this phase of things, especially in buying a home, it's really important not to get yourself in the position to where buying a home is going to be a setback. Because, you know, we're taught that the American dream is to buy a home and go to college and, you know, have 2.5 kids and all of that. But that's not everybody's, that can really turn into a nightmare real quick. Not everybody is meant to own a home. You know, Melba mentioned someone that might be elderly and can't take care of a home. Well, if that's the case, then you're gonna pay a premium every time something breaks down. You're not gonna be able to mow your yard. You're gonna have $200 extra expense in someone mowing the yard, coming in, touching up paint, et cetera, et cetera. So you have to really kind of know yourself and be realistic with yourself on what kind of homeowner you would expect to be, and is it right for you? You might need that landlord to be able to call up and say, hey, my dishwasher's broke, my sink's clogged, etc. Because you need a fixed budget. You need to know exactly what you're gonna have each and every month. And variable expenses are just simply unacceptable. They're gonna cause you a hardship. They're gonna put you into the hole. You're gonna have to sacrifice something that's truly important in your life in order to pay a variable expense that you weren't expecting. Emergency fund. This is, you guys are in a very unique and situation where you have a tremendous opportunity with the grant assistance for the average individual to be able to save $25,000 or to pay $25,000 down on a house. It takes a long time, especially when you're just starting out. So to be able to walk into a situation where you have $25,000 already into the home, it's tremendous. I mean, it is such a huge advantage that I'm really grateful that you guys are able to take part in. But in doing that, I encourage you not to have the mindset of it's free money. It's your money, okay? And you need to protect it. And one of the ways that you protect it is, because the last thing you want to do is go through all of this, overbuy, not budget yourself, get yourself into a situation to where you lose it all and you're never able to recapture it, when this right here, this emergency fund, could eliminate that altogether. And what it is because you're gonna walk into this transaction, you're gonna have some money up front, but you're able to walk away with basically being reimbursed and zeroing out at the end of the transaction. But I encourage you, have 3 to 6 months of savings at all times. And what that simply means is if your house payment is $1,000 a month, have $3,000 in the bank. That's it. Sock it away, put it somewhere else. It is your emergency fund. That way, if you get hurt at work, you lose your job, whatever, your family's safe and taken care of. And that $25,000, which is your money, is protected. And that's simply what that is. So I really encourage that you have that comfort level, and I promise that if you keep that money in reserves, untouched at all times, even if you have to put it into a coffee can and bury it in the backyard because you have a spender husband, do it. Because that confidence that you'll have will change your life. So, let's figure out 5 steps of creating a budget. Does everybody have some paper? Now, Melba had mentioned debt to income ratio, and let me just define what that means. Is take your monthly income, if you're a wage earner or if you're employed, you take the gross. So if you make $30,000 a year, you take that number. You don't take what you walk home with after taxes and deductions and what have you. Take that top number. And then you divide that by the monthly expenses that report to your credit bureau. Car payment, credit card, those type of things. Not utilities, not car insurance, not child care, etc. But the items that report on your credit bureau. Think about it as bank loans.
If you pay your credit card off every month, do they still report how much you spend?
No,
Oh,
but it's gonna change. If you're someone that, and it's gonna change in your favor.
oh, good.
Yeah, because you're called, what's called, people, there was a 2020 or a news report or something like that credit card companies think of people that pay their credit cards off in full every month are deadbeats or what have you. They don't want their business. It's not true. It's completely false. You're what's called a transponder.
Write that
Yeah,
down.
nice little title for you there. And basically what they're going to do is they're, on the new credit report changes, is they're gonna show your spending patterns. So they're gonna be able to show, okay, this person makes the minimum monthly payment. Whereas this person has a balance of, has available credit limit of $1,000, they spend $1,000 every month, but they pay it off. So what was happening is that right now, if you go, every dollar or every percentage, if you will, that you spend above 30% of your available credit limit starts to ding your credit.
It does what, I'm sorry?
It dings your credit, it lowers your score. Ideally, if you have a credit card, you never want to spend above 30%. So if you have $1,000 limit, you don't want to spend over $300, or it starts to lower your score. Okay? If you're maxed out, or if you're in a situation where, you know, I'm doing everything right, I'm paying it off at the end of the month, but I can't get my score above 660. Well, it's because you're maxing it out. You're lowering your credit score because you're maxing it out, even though you're paying it off. Hopefully, with this new credit report that's coming out, that's going to change, and you'll be able to see that payment history. It's like, oh no, these people are actually doing a lot more than what they should be doing as far as minimum payment and that sort of thing, but not yet. Okay, and if you guys, I'm not going to talk about a whole lot, but if you need help with credit issues or how to get that into place, just give me a call. I'll help you with that. Okay, so in budgeting, the biggest thing that you can do here with budget is simply just to write it down. I treat this as kind of a life philosophy, if you will. If I have a goal in mind in life, whether I want to buy a home or I want to accomplish X, Y, and Z, it's not real until you write it down. That's when you're really serious about it. Same thing with the budget. It's not real until you write it down, you put it on the refrigerator door, whatever it does to capture your attention, that this is the way that we are going to live so that we can accomplish X. Okay?
I have a question.
Yeah.
That amount that we get after we divide by the monthly expenses reported to the credit bureau, what does that amount give us?
Your debt to income ratio.
The debt to income ratio, okay.
Some people call it DTI. That's most commonly in lending. A lot of acronyms. So if I start throwing those out, just say, what is that? But debt to income ratio, credit, and what's called loan to value or LTV are your three most important factors in financing. And loan to value is simply the division of what's the loan amount compared to the property's value or sales price. Okay, so if you're putting 5% down, then you got a loan to value of 95%. Okay. This right here is imperative, and to know your numbers or where you're at as far as your debt to income ratio, we're going to get there. Oh, this is
That's
touch
the
screen.
screen. I was like,
All right, I feel like a weatherman. All right. Okay, so with your budgeting is, first thing that you need to do is, if you guys don't mind taking a little participation here, would you mind factoring your debt to income ratio? What I would like you to do is to list your fixed expenses, and then we'll calculate your debt to income ratio with your gross monthly income. Do you mind doing that for me? It'll be private. I just would like.
I do it every month.
You do it every month? Fantastic. So let's go first. Rent. Oh, we have sheets, great.
It's got some things on there that might be on there, and then there's some things that we don't really count.
Okay.
We're gonna get past, it's just the generic.
We're in a room on my hand.
Oh, yeah.
Yeah, right.
We try to find one that would work, but usually you can look on the internet for budget forms, worksheets, and it's just kind of gives you an idea of, you know, where you're at. And like you said, this worksheet that I'm passing out, when we do get your full application, this would be included in your application. And sometimes we will look at that just to kind of get a general overview of what your debt to income is. But usually what we'll really look at is your lender, when he sends us your loan application and everything, that's what we'll look at too. That gives a better picture.
So if we do this, this will determine our debt to income ratio?
Yeah.
Okay.
Yeah. I'd like you to kind of walk out of here knowing where you're at.
Yeah, definitely.
And at the end of the day, if you need to do something, to be armed to be able to do that. Now, as you list these expenses, debt to income ratio again is your installment loans, your credit cards, items that are reporting on your credit bureau. So, if you currently own a home, that's gonna be a part of your debt to income ratio. If you currently rent a home, it's not. It's not, again, it's not gonna be on the credit report. You're gonna vacate that property whenever you purchase a new one. Okay? Car payments will absolutely be on your credit report. Water, electric, phone. Those are your variable expenses. Those are gonna vary each and every month. Now, if you're going from an apartment, or if you've always lived in an apartment where these expenses are relatively fixed, you can call in to each one of the utility companies on water, electric, gas, and so forth. You can call them and say, hey, can I get an average bill of what this property uses? Because if you got a home that's all gas, or you have a property that's all electric, or both, you really want to get an idea of what it has, or what those average expenses are going to be. Or this home has a sprinkler system.
So you could like request from a utility place
Yeah.
the past bills of somebody?
They'll give you an idea.
Oh, an idea, okay, that's cool.
They'll give you a
I
pretty good
didn't know
idea.
that.
Sometimes they're a little coy, but they'll do it.
Sometimes too, they'll go ahead and average it for you, depending
Absolutely.
on how long you've been with the company and stuff.
Yeah, that's right.
That's-
So you really want to put that into your budget as well. If you're gonna purchase an older home or something that is not very well insulated or has older windows, or if you're walking through a house, and this might be covered in real estate, and you see that the argon gas, which is basically the gas that goes between double pane windows, that your windows are foggy, then you know that your insulation might not be very good, and you might have higher utility bills. Last thing you want to do is have this fixed budget and walk into a house and you got $300 a month electric bill. Or you go, insulation is really cheap. Or you look up in the attic, or you don't look up in the attic, and it only has a couple of inches of insulation or something like that, and everything's really high. So you want to get an idea of what that truly is going to be, but that's not a part of your debt to income ratio. Your telephone, I'm sure nowadays that's not so much a factor as far as long distance and that sort of thing. You pretty much know what that is. Insurance. This is a huge variable expense that people neglect. Insurance companies, especially your big three, your Allstate, State Farm, Farmers, etc., your premium is based upon your credit score. As much or more than the house that you're insuring. Same thing with your car insurance. You can call into Farmers, and all three of you, if you were exactly the same, sex, driving record, etc., you would be quoted all different things varying on your credit score. If your credit score is really low, you're going to pay a much larger premium, 50% plus, than what someone with a 740 credit score is gonna pay. Okay, so you have to take that in consideration, because every year, whenever you renew those policies, they're gonna re-pull your credit. They're gonna call it a soft pull, which I really don't think that there's such a thing. But they're gonna reevaluate that. So if your insurance keeps going up and so forth, that could be a good, very good indication if you know that there's some credit issues that are behind there. I've had this become a real factor in that, say again, we budget $1,000 a month for your payment, for your house payment, and I get a phone a year later, Chris, what is going on with my house payment? It went up $150, $200 a month. Right there. Because you're gonna get into a fixed mortgage, a fixed rate mortgage, but that does not mean that your payment is gonna stay the same. Because your insurance and your property taxes are gonna vary. And that's outside of your mortgage company's control. Because your taxes are gonna be based upon your millage rate, or your millage rate with the county, and your homeowner's insurance is gonna depend on whoever you choose. Mortgage company's just paying them for you. So you're gonna set it up, you're gonna go to Farmers, or whoever it's gonna be, and mortgage company's gonna do what's called an escrow. It's just gonna simply just pay them. Okay, so you just be careful there. Food, we know about food. Credit cards is definitely put into your debt to income ratio. Gas is not. Clothes, entertainment, savings. The savings is the 10%. Now, whenever we get into financing, you don't hear this too often, but let's say that, let's use that $80,000, let's use a $100,000 number, if you don't mind.
You're good.
I'm filming right there.
Oh. Sorry. I can do it.
I think if you come right here. So whenever you are looking at purchasing a home, if you're looking at a $100,000 home, or you're pre-approved for $100,000, I say knock it down 25%. That's what I personally feel. So many people want to push that limit. They think of things in monthly. This is my monthly payment. This is what I have. I make X amount and I have this much left over. That means that's what I can afford to spend. That's absolutely a wrong way of thinking, especially when you're living on a budget, or if you want to get ahead in life. Okay, you want to back that down. You want to make things work for you. You want the home ownership to be a positive experience, not a negative. So, everybody have a calculator? And for you two, basically what we were figuring is our debt to income ratio. Okay, which, to recap, are the things that were reported on your credit report, monthly expenses, divided by your gross, or your total monthly income. Okay? So here, we're looking at, on an estimated $90,000, we have a monthly debt of $405. We added a new house payment of $642, which gives us a total expense of $1,047. So with their income divided by their total monthly income, they're at 52%. Too high. Because this is 52% of the total, but it doesn't take into consideration you have to pay taxes out of that $2,000. You have other miscellaneous expenses that come out of that $2,000, and so that's why that 41, in my opinion, is actually a very high number. We'll go there, we'll exceed it sometimes, but usually it's for circumstances that are that make sense, that have common sense, like your situation. Okay, where we have 3 household incomes, if I heard you correctly, where we might be only be able to qualify the mortgage on 2. But we know there's a third that's gonna make their budget work. So then that might make sense for us to, as a loan perspective, again, that's different from the grant, but from a loan perspective, that might justify us going above the 41% requirement. Any questions so far? It looks like this just rolls into financing. Is that okay? Okay, and whenever you guys are ready for a break, just let me know. Okay, so now that we have our credit scores in line, now that our debt to income ratio is in line, you'll get a pre-qualification letter. Pre-qualification letter is typically what any seller or realtor representing a seller wants to see before you purchase a home to proceed. Might be a situation in a new construction where a builder wants to see your pre-approval letter before, you know, going out the expense of drawing plans, doing cost estimates, etc. They just want to see that you have, all right. They just want to see that you have the funds available to purchase the home, that you're serious, that you're qualified. Typically, they're pretty generic. People are usually unimpressed with the pre-qualification letter, okay? And this is one area of concern, which I'll go into in a second, because it just simply states some generic facts. Purchase price, this is what they're qualified for, they're putting $20,000 down, loan amount, interest rate. And then it just states that, you know, we have reviewed their financial information, and that's simply it. Where you have to really watch out here for is there's been some federal law changes. And every lender, every bank is a little bit different in this regards. Is they've made it to where to issue a pre-qualification letter, you don't have to have very much information, which could cause you to get into loan process and have it blow up on you because they didn't check your income statements, your asset statements, and so forth. And what that really does is that really falls back on you knowing the finance process and knowing that you've done everything you can to make sure that that person has the information that they want. Even though they might not request it, make sure that they have it. And I always suggest that whenever you talk to somebody, make sure you're ready and that you have the income documents ready for them to present. So, where people get a little spoiled is, and I did this early on, you know, I was, before I bought a new car, before I financed a new car, and during college, in college, I had wrecked my credit report. I mean, I did college completely the wrong way as far as financing is concerned. But then I went into the mortgage business and expecting that, okay, this dealership's gonna wanna see my pay stubs and my bank statements and my W-2s, and no, they don't wanna see any of that. They're like, well, I just went to a car loan and they approved me. Well, and I didn't have to give a pay stub or a bank statement, they didn't verify a job, anything else like that. And so people get a little spoiled to that. They're like, well, then that means I'm creditworthy. That means I'm financeable. The auto industry was completely unaffected by the credit crash in 2007. They're throwing out money, high interest rates, so forth. So don't take that as an indicator of where you're at. Be prepared. So you want to have your income documents ready as far as your pay stubs, your tax returns, 2 months of bank statements. You wanna have those things, and you want to make sure that whoever your loan officer is has those things. Because the last thing you wanna do is get into the loan process with, well, they pulled my credit, or I did a loan application here, and they said I was good, and then you're moving along, you're out earnest money, you're out appraisal, you're out your inspection fees, and loan officer comes back to you, he's like, well, you didn't tell me that you had a garnishment on your pay, and so it wasn't reporting on your credit bureau, but you have a garnishment here for $400 for child support. Boom, you just lost $2,000 in fees that you had no control over, when that person should have asked you for it, or you just make sure that you give it to them. Okay? And if there's any potential issues like that you think that might be there, just be upfront. Don't, so, well, they didn't ask me about my divorce and this alimony that I had to pay, so it must not have been important. No, they just might have missed it, or nothing was an indicator on the credit report or something like that. Just be upfront, this is what I got here, so that you make sure that this pre-approval letter, this pre-qualification letter is as legitimate as possible. Is that helpful?
Yes.
Okay, all right, because I like to see that this process is as smooth as possible. And where it becomes smooth as possible, where the files get rough and where the files get just streamlined, is on borrower's participation. If something's requested, they turn it around immediately. They don't wait. Okay, they're responsive, they're on top of it, they have their documentation ready. That will make everything go a lot easier in your underwriting process, no matter what lender you choose. If you drag it out, or if there's always a reason why, then think about it in your own world. If you have something in your life where you do a little bit here, and then nothing happens for a while, and you have to pick it up here, you usually have to re-review it, or you forget about the details, or you forget that, oh yeah, that person did tell me about this. Whereas if you're just responsive, then everybody's on the same track, you're keeping everything on track, and so forth. It goes quick. And then when it goes quick, it goes better. Okay? Now, loan application. In a loan application, we have two different options. Some companies require different things. It can be online. It can just be as simple as a web form. It can be something that you actually have to go into a bank or a credit union or whatever, mortgage company, to fill out. We fill it out for our customers. It's just because it, I mean, look at it. That looks daunting. Do you really want to, fill that out? So we try and fill it out for people thoroughly. The more thorough this application is, the smoother your process will be. All your underwriting is, let's just talk about that. Once you're in contract, once you've gotten your approval over here, once you've written an offer on a house and it's been accepted, then you have to go through what's called underwriting. Underwriting is simply this: verifying that everything on this application is true. That's all it is. The sales price, contract is required for underwriting. The value, an appraisal, is required for underwriting. Your Social Security, we do Social Security number verifications. Your addresses, we verify that you live there. Employment history, we verify that you work there and that you make the amount that you stayed through pay stubs, through third-party verification systems, et cetera. That is all underwriting is making sure that this is accurate. I'm not saying that people leave these out intentionally, but they just think that it's not important because it wasn't asked or whatever. That's where problems come around, and that's why financing falls apart in the process. That's simply it. And if you remember that, then you'll have a very good transaction. And, you know, even whenever I hear stories, you know, between people, they're like, well, you know, I went through, you know, XYZ bank and it was amazing. And they talk to their friend who's in the exact same situation. It's like, oh, it was horrible. I couldn't believe it. They just beat me up. They just kept asking me for things. Well, they kept asking you things because you didn't give it to them. Or they had to keep asking you things. I'm not saying you don't get a bad loan officer or bank, but that's all underwriting is. So if you're quick and you're thorough, it'll be a smooth process for you. Okay? Now, I do want to talk about, this is awesome. I'm just going to sit here and mess with this for a while. Let me go through a couple of key definitions here along in the process. You're going to have different finance options. Okay, what you're going to really want to be concerned with is, what are my costs? What is my rate? And how much are my payments? Okay. Each program here, these are the major ones: VA, FHA, conventional. Other is usually the HUD 184 program. Each one's going to have its own thing. Now, in comparing them, and I don't expect you to remember this, but I just want you to know that there's options. Government loans typically have what's called an upfront mortgage insurance premium that is financed into the loan. Okay, so what that means is, let's just take VA for example, because it's one of the most expensive. Actually, USDA is probably the most expensive, but well, let's take USDA. If we're going to finance $100,000, remember I told you it's 100% financing, but they charge an upfront mortgage insurance premium. It varies from year to year. It's varied from 2% to 3%. So what happens is your base is on that 100,000, but they add that mortgage insurance premium on top of your loan, so you're going to finance 103 for the life of the loan. Whereas if it's advantageous, you might go with a conventional loan, which does not have that fee. Yes, it might require you to put 3% down, but down payment is not, in my mind, is not a cost because you're paying it down. You're trying to get your mortgage to zero, whereas a closing cost is a fee that does not pay down your mortgage. Just like that mortgage insurance premium, it's a fee that's added on for the government here or the Veteran Affairs to guarantee that mortgage, to offer you 100% financing, or USDA or whoever it is. It's what they get. It's the fee they get for guaranteeing and doing 100% financing.
And what did you say that one was called, what it's called, rather than the upfront mortgage insurance premium? The one where you put the 3% down?
Oh, and that might be conventional.
Oh, okay.
Each one has its own requirements. VA, for example, is 100% financing.
Mm-hmm.
Besides the 184, that, I mean, if someone's a veteran, I'll usually present that to them pretty quick because it's a
That's
fantastic
kinda
loan.
okay.
USDA, I was just giving that as an example, is where it's alluring because it's 100% financing,
Yeah.
but it's very costly.
Okay.
It's just, you might not have to bring money to the table, so to speak, and table just means that when you close on the transaction, you might not have to bring that, but you're gonna finance it for a long time, for
Okay.
30 years. Okay, So closing cost, that's what I wanna go into here. Will include any mortgage insurance premiums, appraisal. An appraisal is not an inspection. An appraisal determines the property's value. An inspection determines the condition. Okay, appraisals range from anywhere from, some will say 300, most are normally around 490, 550, right in there, and they do vary upon location. You'll have your title fees. Your title fees include several different things. Your closing fees, title insurance, which title insurance protects two parties. It protects you and it protects your lender in the case that the title work was done incorrectly. So let's say that during the process, in which the abstract is basically the history of the land, it's a book. In updating that abstract, they missed that someone had a lien on the property. Well, if that wasn't insured, that would be whose responsibility? Yours. So as a lender, we require to be covered, because we don't want to be responsible for their mistakes. We don't want to lend $100,000 and have somebody come back on us for $1,000 and trump our lien. Because it's simply who puts the lien on first is the one who takes priority. Okay? All of this will vary in prices. It varies upon your loan amount. It varies upon location as far as your government recording fees and so forth. Closing costs for the average transaction in Oklahoma is anywhere from $2,800 to $3,200 with all your title fees, etc. This is something you can shop for. Most companies, whether it's a mortgage company or if it's a real estate company, they'll typically go to whoever they go to. Now, if you're using the grant assistance, they have a fantastic closing and title department. You'll want to stay with them, okay? But if you were looking outside of this area, you might consider something else, because they're very competitive. They stay very competitive because they have a relationship with the tribe and so forth. So, but if for some reason you don't use the grant assistance and you go outside of the bubble here, for lack of better words, know that you can shop for those fees. You can shop for your interest rate as well. Every lender is going to have different interest rates and different costs associated with those interest rates. Are you with me so far, or am I good?
What was the other thing under title fees? Those closing fees and what else?
There's several. There's government recording fees. And closing costs are typically used generically to cover all of that. Now, the one thing that you need to be aware of, if you're gonna, is from the lender side, is the lender has fees. And those are many times negotiable, but they're definitely comparable. Okay, because they might have administrative fees, processing fees, XYZ fees. I mean, I've seen the names just of these fees just range. And typically, how you get down to the bottom of it, of what are their fees, is it's called Section 800. There's a loan estimate that the lender is required to give to you upon request, and in the Section 800, it states their fee specifically. I know you're not going to remember that, but if you have any questions along the way, just let me know. So, in that, what you really want to be concerned with, and what I'm not a big fan of, I can count on my hand the number of times that someone has chosen this option, is paying loan origination or loan discount points. So for example, what you can do is you can basically prepay interest to get a lower interest rate. So when you log in online, let's say you go to bankrate.com and you see that one lender is offering, see today's rate is 3.5%. But you see one that has an interest rate of 2.75%. Why such a big difference? Well, when you get down to the cost, their fees are so much more because they're charging you those fees up front. You're prepaying that interest to get a lower interest rate. Very few people recover those fees. Typically, if you're buying it down an interest rate, it has to be usually marginal, and you have to be very confident that you're gonna be in that home a long time to recover. Because you might be thinking, okay, well, I'm at 3.5 here, I'm at 2.7 here, my payment might be $50 lower, but I'm paying $4,000 in discount points, origination fees, and so forth. Well, you take that savings, let's say it's $100 a month, and you divide it into that, how long is it gonna take you to recover those fees? In this scenario, with what this program is, I can't think of a reason why it's beneficial to do that. Keep your closing costs, keep your fees down, and just make sure that you understand what all of the fees are on the loan estimate that you should receive. Always ask what the costs are. Interest rates will vary with market conditions. Okay, they change on a daily basis. Right now, they're on the upswing a little bit. Doesn't mean they're gonna be 18%, but it might be an eighth. You know, instead of 3.5, it might be 3.625 by the end of next week. Or it could go down to 3.375, like they have been. Overall, they've been trending down. Now they're just ticking up a little bit. So don't be afraid along the way. After you receive your pre-approval letter, shoot your loan officer an email, a text, whatever. What are rates doing? Are they going up? Are they going down? Where are we at in the process? Eyes glazing over yet? No? All right. Typically, on the loan application, if you'll remember two, you're gonna have to supply 2 years of everything. 2 years of income, 2 years of residence history, 2 months of bank statements. Bank statements. No overdrafts. If there's overdrafts on your account, reestablish that account. Don't give a bank statement to your lender with overdrafts. She had mentioned something that was very important as well, payment shock. Payment shock is where I'm renting for $500 a month currently, and I'm going to go to a house payment of $1,000 a month. If you have overdrafts on that account, can you handle that payment? The answer is no. Your debt to income ratio might show that you can, but you don't manage your money in a way that indicates that you can handle that payment. That is payment shock. Okay, that's where the underwriter goes, okay, you have a $500 a month extra expense here, and you have shown no history of saving. You're going in the red each and every month. It's not in your best interest to buy this house. You need to look at that. Okay? I understand the bank covers it. I understand that the banks can do all kinds of things in regards to that, but you need to make sure that you're not going out those expenses. Number one's of the overdrafts, but number two, you need to look at, you need to know yourself. in your budget that, hey, I'm saving $700 a month. I'm increasing my house payment by $500, but I'm saving $700 a month. I know I can afford that house. Not, hey, I have $500, I'm gonna spend it at Quick Trip and you know, my kids got soccer, my kids, you know, we're just blowing and going. This is our normal lifestyle, and I can't, and I'm going in the red every month. Don't jump into the bigger payment. I'm not saying that's bad, I'm saying that's just life. You know, you don't want to jump into that, you know, look at your, you know, just sit down and go through your last bank statements and see where you're at. How much are you ending up with at the end of the day? And renting versus owning, right now, because the interest rates are so low, most scenarios, you're going to lower your monthly payment for an equivalent house. Unless your eyes get real big and you go, oh, well, he approved me for $271,000, and I just go jump in. Okay, so take a look at that as far as your affordability, because that payment shock is really going to tell you where you're at. How much are you saving after you live your normal everyday life? How much is left over at the end of the month? Is there anything left over at the end of the month? If the answer is there's nothing left over at the end of the month, then you know if you're going to buy a house, you need to lower your payments. Because guess what? As soon as you get into that house, you're going to live exactly the way that you normally live. It's not going to change. You're not going to cut back. You might for a few months, but you're going to go back to your normal life, and that's to be expected. But you don't want that normal life to become a hardship, because now you bought a home and you didn't realize that things break. You know, a heat and air system on the cheap side, if you had to replace that, $7,000. Hot water tank to have it installed, you know, $400 at Home Depot to have installed, $1,500. Roof, Oklahoma has every season and every weather event. We have high winds, we have extreme heat, we have extreme cold. Roofs only last about half of whatever their rated life is. So if you got a 30-year shingle on the house, it's only going to last 15 years, unless you go with you know, a more expensive metal composite material that's really meant to withstand that. So in your affordability and in your financing, to kind of sum it up here, and in your budgeting, it's real easy. To realize where you want to be, simply write it down. Look at what you're currently doing with your current life and your expenses, and make sure that what adding this big transaction is going to do for you. Is it going to better you, or is it actually going to hinder you? And that's how you know if you're going to be a good homeowner. Questions? Any questions on the financing? Because I combined the two, the budgeting and the finance. Any questions on the definitions of appraisal, inspection, so forth?
Okay, so I guess I have one for the, what'd you call it, mortgage lender. Is it possible sometimes with that section 800 paperwork that you said, is it possible sometimes they kind of like try to gyp you, like with fees that really should be on them?
Well,
Does that make sense?
yes, it does. In my mind, is in this process, you have to take ownership, and you have to control it. It's going to happen exactly the way you want it to be. If you're not involved, or you're making assumptions that people are going to do the right thing and do what they're supposed to do and so forth, then that's exactly what you're going to get. If you stay on top of it and request the fees, and this is what you provided me, Chris, you know, when I applied here, I asked you for a loan estimate. You told me that this is what it was going to be, that you told me that this is where your fees were going to be. Why did they change? They shouldn't have changed, etc. Then you can hold that person accountable. Whereas if it's a situation where it's like, well, I called in, I applied, they told me I was pre-approved, I didn't ask for anything, and now I'm in a contract, I'm about to close, I got the U-Haul sitting out front of the title company, kids are crying, dogs are barking, and now you're evaluating the fees, you get yourself stuck.
Yeah.
Now, in this scenario here, you're in a pretty good situation because you have Melba reviewing the cost estimates to see if they're in line. You have lenders that are pretty trustworthy here, and then title companies that have been worked with before, and so we pretty much know what things are going to be within a few $100s.
Okay.
So, is it on them? Are there repercussions if they jip you? Absolutely. There's the Department of Consumer Credit that handles licensing of loan officers. But where I see the mistake most commonly, because we do have a lot of people that'll switch over to us in the process, is this application here, this is very misleading. This is 4 pages. What you get is probably about 55 pages of loan estimate, all the federal law disclosures about discrimination, all of the signature authorizations to be able to talk to different people for you, all of the compliance, just lots and lots of compliance and paperwork. And the forms, you have not only lenders' forms, but you have the government's forms, then you're gonna have their forms. And what happens is people just go,
Yeah, that's what I would do.
you know, and before you know it, I mean, you signed off on everything.
Yeah.
So what repercussion is there really?
Yeah.
Where really what you need to do is you're entitled to a copy of everything. You're entitled to the appraisal, you're entitled to the title work, you're entitled to the survey, you're entitled to copies of everything that you signed. Look at it.
Yeah.
Because you're gonna be stuck with it for 30 years. And at the end of the day, and I hate to say this because it's callous, I understand that people were legitimately taken advantage of with predatory lending and that sort of thing, especially prior to 2007, 2008. But most of those people just went off of what they heard and not what was in front of them. So they go, well, I'm a victim of predatory lending. He told me that X, Y, and Z was gonna happen and my payment wasn't gonna increase, and et cetera, when they signed 55 pages of documents otherwise.
Yeah.
And that's where, so you really have to just take your time, look at everything. Even if you don't understand it, look at it. Even if your eyes glaze over, and it's because it's all just legalese. Take a look at it, ask the questions. If you do that, or sit down with Melba and go, what does all this paperwork mean? I have no idea. I'm speaking for you.
Yeah.
But, or with your lender, the person that you're dealing with should not be rushing you through the process. They should be able to sit down, go through it with you, and be able to operate as fast or as slow as you want them to. Does that help?
Yes, thanks.
I would hate to get hit, but like you said, all those fees,
Yeah.
and not know, why didn't nobody mention all these fees of, where are they going? Cause it's like that, I wanna know where this money's going.
Absolutely, because, and especially in this situation, because you have $25,000 that's given to you. How much of that is being applied to your principal and paying down your mortgage, and how much of that is going to your fees?
Exactly.
If you're just looking at the bottom line here, and you're just seeing that, well, I didn't have to bring anything to closing, this went well. But all of this here is just loaded up, yeah. And you're only, that 25,000, you got 15,000 going to principal, and the rest is just going to fees.
So can you change that? Like if it is all loaded up, can Can you request that?
Absolutely.
Oh, wow.
I mean, the good thing is that you can stop at any point and walk away. Will there be a cost? Maybe. Most situations not. Okay, so let's say that you get in here, you got earnest money into the transaction, you've done, let's say $1,500 in, you've gone out $1,500 in inspection fees and all this miscellaneous things. You're buying a $100,000 house. This is getting loaded up. Is it better to have $10,000 loaded and put on top of you that you're gonna finance for 30 years, or is it easier to bail on $1,500 and just reset? Neither one is ideal. I'm not saying that that's perfect. I'm just saying you're in control and you can stop it. Or you can stop it and go, oh, you know what? I don't like the situation I'm in, I'm gonna go with another lender. Okay, I need to extend my contract another 30 days, you know, to purchase this house because I need to go and have X, Y, and Z done somewhere else. Just because you stop it doesn't mean you have to lose. Just make sure that you're in conversation with your realtor or with the seller or whoever it is that you're in negotiations with, that you're getting exactly what you want. It doesn't happen that often, but it does happen. You know, so if you're getting in here and you get closing costs where, I've seen this too, where the lender just quotes you their fees and they don't quote you everybody else's fees. So you're like, wow, I've got a lender over here that's quoting me $2,000, but it doesn't include everybody else's fees into it. And then they come here, and then this is all loaded up, this is zero, so everybody's happy, and it closes. But then the amount of principal that they're putting down is all eaten up. Doesn't happen that often, but I've seen it. So you just need to make sure that, is this everybody's fees? Are there title fees in here? Are there government recording fees in here? Is this my number?
You want that up front.
Absolutely.
You need that up front.
Absolutely. And there's no reason why you shouldn't get it. You know, some lenders will say, well, there are a lot of different variables. I really can't give you an estimate because I don't know what property you're gonna choose, or I don't know X, Y, and Z. Push the situation a little bit. Just say, okay, all of that is true, but I want a cost estimate based upon $125,000 in Broken Arrow. Okay, make them put a scenario together so that you have an idea. Because at the end of the day, you want to take advantage of this program and you want to make sure what it is intended to do, which is to help you build wealth through the home, that money is being applied to your principal. And then, this might be a little bit too much for you, but there are also different fee structures where you can actually have the lender pay your closing cost. Okay, that gets a little bit tricky in that basically what it is, it's called a lender credit, where let's say the interest rate today is 3.5%. If the lender charges you 3.75%, then that lender is going to receive more compensation for the higher interest rate charge. They can give you that compensation and pay your closing cost, so that more of your money is going to your principal. That might not be beneficial to you, but it is an option. Questions? All right, did I cover everything?